Andrew Ross Sorkin's 1929 is more than a history lesson. It is a gripping, hour-by-hour narrative of human ambition, fatal hubris, and the dizzying speed of financial disaster. Drawing parallels to the 2008 crisis he masterfully chronicled in Too Big to Fail, Sorkin plunges us into the gilded, reckless world of the late 1920s, showing how the seductive illusion of effortless wealth blinded an entire nation. The story unfolds through the eyes of the titans of the era, the bankers, the industrialists, the politicians, who collectively believed they had tamed the economic beast, only to watch it devour them. This is the definitive account of the market's psychological descent, from euphoric confidence to paralyzing panic, revealing the fundamental flaws in human nature that guarantee the crash will always be followed by the crash. We explore the full trajectory, from the giddy highs of the new era to the devastating lows that launched the Great Depression. The Golden Age, Euphoria and the Illusion of Permanence. The decade of the 1920s roared with an unprecedented symphony of technological innovation, jazz music, and above all, easy money. Wall Street had transformed from a distant, elite club into a national obsession. Stock ownership was no longer reserved for the wealthy. It was a democratic pursuit, a shared national pastime, advertised and celebrated in every newspaper. This era was defined by the charismatic figure of Charles E. Mitchell, the head of National City Bank, later Citibank, often hailed as Sunshine Charlie. Mitchell was the perfect embodiment of the age, a self-made man who aggressively marketed stocks to the masses, pushing the narrative that buying stocks was a patriotic duty and a guaranteed path to prosperity. The bedrock of this financial house of cards was the practice of buying on margin. Investors only had to put up a small percentage, often as little as 10%, of the stock's price, borrowing the rest from brokers. The returns, when the market soared, were astronomical, fueling the illusion that poverty was obsolete. This vast pool of credit was called broker loans, and it grew to unsustainable, dizzying levels, drawing cash not just from banks, but from corporations and wealthy individuals seeking risk-free, high-interest returns. The psychological impact was profound, a collective delusion that market cycles were obsolete, and that the bull market was a permanent fixture of a new era of American economic dominance. This euphoria was not confined to the professional traders. It was the story of millions of ordinary Americans, school teachers, cooks, secretaries, who drained their savings or mortgaged their homes to participate in what felt like a universal, unstoppable lottery. Sorkin meticulously captures the intoxicating atmosphere, the ticker tapes flashing across every barbershop and saloon, the shared, almost religious belief that wealth was a birthright. This widespread speculative fever was the engine, built on the fatal psychological flaw of the crowd, the seductive, dangerous idea that this time is different. The Cassandra Chorus, Warning Signs and Dismissed Skeptics. While the nation danced on the escalating pyramid of debt, a few solitary figures stood on the periphery, their warnings drowned out by the noise of the booming ticker tapes. These were the Cassandras, the skeptics and economists who identified the structural rot beneath the shimmering surface. Their primary concern was the toxic growth of broker loans and the dangerous level of margin buying, which meant that a small drop in the market could trigger a colossal wave of forced selling. The institution best positioned to intervene was the Federal Reserve. Its chairman, the hesitant Roy Young, and other board members recognized the danger but were paralyzed by internal disagreement and political pressure. Should the Fed use its most powerful tool, raising interest rates, to curb reckless speculation, even if it risked slowing the productive parts of the economy? Wall Street, personified by the powerful Charles Mitchell, fiercely resisted any interference, arguing that the Fed had no right to police ethical behavior or interfere with the efficiency of the free market. Mitchell himself even stepped in to inject massive amounts of his bank's money into the broker loan pool, effectively challenging and undermining the Fed's timid attempts to tighten credit. Political denial compounded the failure to act. President Herbert Hoover and Treasury Secretary Andrew Mellon publicly maintained an air of calm confidence. Mellon famously stated that any downturn would be a mere wholesome liquidation, dismissing the structural weaknesses as minor adjustments. The skepticism of economists like Roger Babson, who openly predicted a devastating crash, was ridiculed by the financial press. Sorkin details these internal and external battles, showing that the crash was not an unpredictable act of nature, but the inevitable consequence of deliberately disregarded alarm bells and a fundamental unwillingness by those in power to puncture the pervasive, profitable illusion of prosperity. The system was rigged for collapse by the very hands that refused to protect it. The first tremors, the October buildup and market fragility. The summer of 1929 had been characterized by one last ecstatic burst of speculation, with markets hitting dizzying, unsustainable peaks in September. But by early October, the first serious tremors began to shake the foundation. These early dips were initially dismissed as healthy profit-taking, but the underlying nervousness was palpable. Whispers of overvaluation turned into murmurs of doubt. The critical psychological shift occurred in the days leading up to the final crash. As the market started falling, the mechanics of the margin system began their relentless work. Brokers, worried about the value of the collateral backing their loans, began issuing margin calls, demands for investors to immediately put up more cash or face the forced liquidation of their stocks. This created a terrible feedback loop. Falling prices led to margin calls, which led to forced selling, which drove prices down further, leading to more margin calls. Sorkin uses meticulous detail to reconstruct the internal chaos among the leading institutions. The lack of standardized communication and the antiquated technology of the New York Stock Exchange, NYSE, meant that information flow was agonizingly slow and often inaccurate. The market was already fragile, its participants mentally exhausted by the relentless pressure. October 23rd served as the true dress rehearsal for disaster, a day of massive volume and serious broad-based declines. While not the infamous Black Day, it was the moment that the collective euphoria finally curdled into widespread, crippling fear. The public was beginning to realize that the market was not an unstoppable machine, but a precarious mechanism built on debt and panic. Black Thursday and the bankers' desperate rescue attempt. The financial world exploded on Thursday, October 24, 1929, a day forever etched in history as Black Thursday. The selling pressure was immediate, relentless, and unprecedented. Opening prices for major stocks vanished almost instantly as traders realized there were simply no buyers. The market ceased to function. There were blocks of stock being offered at any price just to find a bid. The trading floor of the NYSE descended into a terrifying, visceral chaos, a deafening roar of shouting, pushing, and the frantic ripping of order tickets. The antiquated ticker tape, meant to convey information, fell hopelessly behind, leaving investors across the country ignorant of current prices and fueling mass paranoia. In the midst of this pandemonium, the true power brokers of Wall Street assembled in a desperate emergency meeting at J.P. Morgan's headquarters, later moving to the New York Federal Reserve Bank. This meeting was the moment of high drama Sorkin excels at capturing. The key figures included Thomas W. Lamont, the senior partner at J.P. Morgan & Co., Albert Wiggin, head of Chase National Bank, and the aforementioned Charles Mitchell. Their goal was simple: restore confidence by publicly demonstrating that the financial titans were united and ready to backstop the market. The plan centered on a dramatic show of force. Richard Whitney, vice president of the NYSE and acting on behalf of the banking consortium, strode onto the floor and, in a legendary theatrical display, placed a massive, high-profile buy order for U.S. steel stock at a price far above the going rate. This symbolic act of coordinated buying worked momentarily. It stemmed the panic, and the market closed slightly above its worst lows, leading the newspapers to optimistically declare that the crisis was averted thanks to the Morgan rescue. But the calm was superficial. The financial titans had bought time, but they had not addressed the structural rot, nor could they combat the fundamental psychology of mass fear that had now taken root. Black Tuesday and the total collapse of confidence. The bankers' theatrical rescue on Thursday bought a fleeting moment of relief, but the subsequent days demonstrated the utter failure of collective will against systemic panic. The weekend was spent with bankers reassuring the public, but beneath the surface, the structural hemorrhaging continued. Brokers demanded more collateral, and investors outside of New York, unconvinced by the dramatic floor show and still traumatized by the inaccurate ticker tapes, began dumping their holdings. The final catastrophic blow came on Tuesday, October 29, 1929, Black Tuesday. This day was defined not just by massive selling volume, but by the complete psychological collapse of the investor class. It was a stampede. The sheer volume was staggering, far exceeding the exchange's capacity to process. Orders were processed hours late, often at prices far lower than the seller expected, wiping out fortunes instantly. The buying pools established by the bankers on Thursday were quickly overwhelmed and dissolved. They had run out of money, or more accurately, they ran out of the willingness to lose any more. The losses were total and immediate. Fortunes built over years vanished in minutes. The market shed billions of dollars in valuation, representing not just paper losses, but the real savings of millions of Americans who had bought into the era's illusion. Sorkin captures the horror not just through numbers, but through the visceral imagery. The crowds gathering outside the NYSE, staring up at the windows, and the panicked rush to the brokerage offices where investors were informed they were not just wiped out, but now indebted to their brokers. Black Tuesday was the moment the great bull market was officially declared dead, and the era of easy money was violently extinguished, ushering in a winter of despair. The aftermath: shattered nation and the scramble for power. The immediate aftermath of the October collapse was marked by a chilling wave of ruin and desperation. Suicides became a morbid hallmark of the financial district, as once mighty financiers realized the totality of their ruin. Beyond Wall Street, the collapse of market prices had a devastating domino effect on the banking system. Banks had financed the broker loans, and the losses led to a cascade of bank failures across the country, wiping out the life savings of those who had never even owned a stock. The crash, initially a problem of finance, quickly became an economic and social catastrophe, the beginning of the Great Depression. The political reaction was characterized by denial, a desperate search for scapegoats, and a furious power struggle between Washington and Wall Street. President Hoover initially maintained that the economy was fundamentally sound, refusing to acknowledge the depth of the crisis, a failure of leadership that would define his presidency. Conversely, Wall Street titans, having failed to save the market, now scrambled to protect their reputations. Charles Mitchell, the symbol of the boom, was soon targeted for his aggressive and ethically questionable practices, leading to his eventual downfall and indictment. Sorkin's final analysis centers on the enduring lessons. The crash was not simply a consequence of economic factors, but a profound failure of human psychology, the shared inability to see the bubble while inside it, and the unwillingness of regulators to preemptively intervene for fear of being unpopular. The book concludes with the historical legacy. The crash of 1929 was the crucible that forced the creation of modern financial regulation, most notably the Securities and Exchange Commission, SEC, and the Glass-Steagall Act, laws designed to prevent the recurrence of such hubris. Ultimately, Sorkin argues, the story of 1929 serves as a crucial blueprint, a haunting reminder that in the cyclical nature of finance, the greatest danger is always the comforting, seductive illusion that this time is different.